Good morning, everyone. It's Thursday morning, about 8:25 in the morning. We're doing we're actually doing two videos this week. This one is more an investor's update, really looking over the last few months, looking at the events that have gone on, not only through this pandemic we've had, but also prior to that. A lot of things have happened. A lot of tax laws changed even before the pandemic happened. And so I just kind of want to summarize it all for you here. This will be our longest video so far. I don't expect this to happen every time, but I just wanted to give you a good update of kind of where we're at and put it in perspective on not only the markets, but overall the different tax bills that have come out from the feds and strategies we can use going forward. So I'll give you a brief update here, and then I want to discuss some planning ideas and strategies as we move into our next quarter reviews that are going to be starting. Some will be tomorrow, but basically next week, we're starting a second quarter review. So with that, I've got my assistant Lacey here. She's helping me, so bear with us. So she's clicking through things so I don't have to think about so many things. What we're going to do is you see me here, but we're going to go to a slideshow presentation, and then I'll come back to you after the presentation. First thing we want to say to you is stay positive, stay safe. I've said that in the last few videos. Staying positive is key here. It's hard to do when you're watching the media. We'll talk about that. We're all experiencing challenging and unprecedented times, but as Ralph Waldo Emerson said many years ago, the first wealth is health. We want to make sure everybody stays healthy. It's imperative. I want to come back and readdress it. So those of you who've come to our workshops, educational workshops, there's always 5 areas of financial planning that we look at. It's important to review these areas. They are preservation planning, retirement planning, tax planning, estate and investment planning. Even though today's presentation is about the equity markets as a comprehensive wealth management firm, we try to consider the impact of any recommendation we make on not just one, but all of the areas for you. And that when we're done here, you'll see that we're not only going to be talking about the markets, but as we do our next quarter reviews, probably for most of the year we're going to be looking at tax planning as well. What if I told you a year and a half ago, what if I told you that the U.S. is going to, or the global recession was coming, the U.S. might start a recession, there was going to be a trade war with China, the president was going to get impeached, the Middle East would fire rockets at U.S. military bases? Would you expected the market to go up during that time? Probably not, but in fact it did. 2019 was a healthy year. And despite all those concerns, 2019 was very healthy, and 2020 started off very strong prior to mid-February. Then in mid-February, after making a new all-time high, things changed quickly. A silent but deadly virus quickly decimated an 11-year bull market. After the strong year that was not foreseen in 2019, in less than 3 weeks, the S&P fell from a 52-week high to a 52-week low. This quick waterfall of the equity markets has set many records. Although most experts predicted a reasonable year for 2020, we are now in an unexpected period where it seems as if the economic outlook is evolving daily. In the equity markets, knowledge is power. I've said that a lot, especially those who've come through the class. That's why I like having people come through this class, my investment class. Educating you, that's why we do the educational workshops. We want you educated. I want you to understand. I don't need you looking at this every day, but I need you to be more educated always. I've been doing this a long time, and I learn something every day. So I believe educational client is our best client. So let's examine some of that data. Let's look at this equity markets over the last 11 years. I can't speak today. We have quickly entered a bear market. A bear market is defined when the market falls at least 20% or more from its 52-week high. The bear market's most basic principle is that bear markets are a part of the investment experience. We're going to have them. I said that to you. This won't be our last one. It's the only thing I can tell you for sure. Over the last 120 years, we know the next 100, we'll see more of this kind of stuff. It's unfortunate. Markets come on sale and bad things happen. A bear market's most basic principle is that bear markets are a part of the investment experience. Since entering the bear market as of early April, bounce back of equity markets may have ended this bear market, but we're still in a very volatile times and are down from all-time highs. The discussing bear markets, the close of 20% down, it might be helpful to review some information about bear markets. There's three categories of bear markets. The first one is structural. Structural bear markets are those created by imbalances and financial bubbles, very often followed by a price shock such as deflation. This happened in 1929 and again in 2008 with the Great Recession. And that's when the financial system was in trouble. A cyclical bear market are ones that are typically a function of the economic cycle, marked by rising interest rates, impending recessions, and falls in profits. An event-driven bear market are created by events such as war, an oil price shock, an emerging market crisis, or like most recently, a sudden viral pandemic, COVID-19. We are currently in this event-driven bear market. These are the bear markets that are hardest, if not impossible, to forecast or navigate. And COVID-19 created a first of its kind bear market, one that was caused by a virus. We've had event-driven bear markets, but none were created by a viral pandemic like this. Equity markets review. What are some facts investors should know? After lowering the federal funds rate by half point to 50 basis points to a range of 1.0% to 1.25% in between its regular scheduled meetings, as a response to the risks the COVID-19 coronavirus outbreak was creating, the Federal Reserve cut its benchmark interest rates in mid-March by a full 1% to 0% to 0.25%. That's 0.0025 of 1%, basically zero. When the Fed started reducing interest rates, many experts noted that the central bank was catching up to where markets had headed. Now it seems as if they both are responding to both the economy and the fact that the 10-year Treasury had fallen to all-time lows. The all-time low for the Fed funds rate is effectively zero. The Fed has only lowered their rate to a range of 0 to 2.25 twice, once during the crisis of 2008, and then once just recently here in March of 2020. The U.S. government, in its response, trying to prevent the threat of a recession and help businesses, they've passed several bills, including the $2.2 trillion Coronavirus Aid, Relief, and Economic Securities CARES Act. This emergency relief package is the largest economic relief package in U.S. history. It is absolutely amazing, and it was so large, and I think done so quickly that we've seen some of the after effects of that, running out of money with a small business, and not being able to get the money into the hands of people as fast as they wanted or people wanted. And we've seen the effects of that. As if things were not bad enough, then the oil price war between Saudi Arabia and Russia emerged suddenly and dramatically on March 7th, which decimated the energy industry. Oil prices saw the worst month and quarter in oil price history, which was down over 50%. Energy companies and oil still being a contributing factor to the overall economy, oil prices added to the equity market's problems. A lot of you have asked me, is there areas of opportunity in oil? Yes, I believe there will be, but again, patience. There's going to be a lot of companies that go bankrupt out of this as well. And we know that, especially from the 2008-9 situation, the financial markets and what happened out of there. A lot of things, solid companies came out of that, but a lot of companies went away. And it's one of the things too that are going on, even right now, here and there, I get calls, people wanting to do this or that, or they've done this or that. Be careful here. A bad decision could be harmful to you. These are not the times to be making radical changes in your portfolio. This is where patience prevails. As this chart shares, the 6 biggest point declines and 6 biggest point increases in the Dow Jones Industrial all came in the last 5 weeks of this quarter. So on March 12th, the Dow Jones fell 2,352 points, which was over 9%. Had you sold that day, you missed the next day's March 13 rise of 1985, which is also a 9% change. The level of volatility is unprecedented, and therefore even the savviest investors need to proceed with caution. And I've said that for a long time now. We're still in a very cautionary position. Even the great legendary Warren Buffett, very interesting here. The volatility and turbulence of this current economic and political environment has caused even some of the most seasoned investors to become skittish, which in March, legendary Warren Buffett said he hadn't seen anything like this coronavirus pandemic. Bespoke explained in a post noting that the average stocks in his top holdings on March 24th were down 37% from their February highs. I don't know anybody that we have who's down even close to that. Perhaps the most important thing to think about is that, like everybody else, his portfolio obviously hasn't been immune to all this volatility. This is a good time to recall one of his most famous quotes, which I've mentioned before. The stock market is a device for transferring money from the impatient to the patient. The word patience is vital here. So we need to be prepared, not scared. We need to manage through this, as I've said, which we've been doing. In the last few weeks, we've been buying people that have been sitting in cash. We've been slowly putting that money to work. As we move forward, there's some other things we want to do with people that have diversified portfolios. And again, we want to be prepared, not scared. So how should we move forward? One of our responsibilities is to look at all situations and guide our clients with ideas. Even a treacherous downfall has opportunities. So let's review some of them. We want to always be thinking long term. It's the way to look at these equity investments. Typically, the most successful investors think and act for the long term, and it's so important. It's hard to think that when we're all stuck at home watching the media. It makes it very difficult. By the way, the media, we'll talk about that in a minute. Let me keep pounding on that. Stop watching it. Some of you are making bad decisions. It's impossible to predict these market losses. So again, we want to stay away from televisions. Why no one likes losses from tax standpoint, that can be helpful. A tax swap is what we're looking at, a strategy that involves selling an investment that has losses and replacing it with similar but not identical investments, because we want it to be, we don't want to get in a situation where we're selling one thing and then buying it back within the 30-day period, or it goes against what we're doing. When we take these tax losses, they can be offset against gains, or it could be banked to offset future gains. We did a lot of this in 2008 and 2009. And as we came out and the markets recovered, we were able to take those losses and offset them with gains. So even though some of you might have losses in here, in some cases, I'm actually capturing those losses. I've been doing that the last few weeks. We'll continue to do that as we go forward in this next round of reviews. It's fairly easy in these portfolios to take those losses and capture them, and then we'll bank those, and then we'll get back into the markets over time. And then we'll be able to use, as the markets recover over the next couple of years, we'll again use those become your best friend. So a bad time can become a good time later on. Again, maintaining a properly designed and well-diversified portfolio is important. Now is a good time to look at your portfolio and considering a rebalancing that might be needed. For example, a 60-40 portfolio, when markets go strong or markets go weak, it changes that. So we're looking at everybody's risk profile. We'll be doing that even heavier going forward. In some cases, some of you we might get a little more aggressive. In some cases, we might need to get more conservative, especially as we move into the next couple of years. Some of you are getting closer to retirement. I've been telling a lot of you this here in the next 12 to 18 months in our reviews. We've got great time in history here that we'll be we've got all these numbers to the end of the year, 2019. We'll have all these numbers in 2020, especially through this period. We'll be able to look back and do some great reviews and look at risk profiles and say, okay, going forward for the next one, the next cycle, what do we want to do here? In the recent CARES Act, one of the neat things they did, and they did this back in 2009 as well, is the RMDs, required minimum distributions. They have all been waived for 2020. Some of you may not need to take distributions from your retirement account at this time. If you're comfortable with suspending the distributions and looking for a potential better time to take them, we'll discuss that. You either call me or we'll discuss that through our next reviews. Also, some of you, we've been doing this even prior to this year. Some of you have been looking at Roth conversion strategies. A great time with the tax bill that changed here about a year ago. It really made us look at converting money from traditional IRAs to Roth IRAs. Even more so now as accounts are down. But it's not for everybody, so we have to be careful. There's a lot of study that goes into this. This is why we look at tax returns, one of the reasons. So we're looking at these opportunities for you. The other thing we want to be looking at on these Roth conversions and remembering is we're in an election year. So depending on who wins this election or how much the government injects into their stimulus, there's a chance for some investors that these brackets might rise. So this is, again, just going to be another good year to look at this and get some of this stuff converted. Also for many retirement accounts with equities, with the values down, this again can create opportunities because we're in those low tax brackets, 12, 22, and 24% brackets right now, which we know in 5 years are going to change no matter, we have to assume they're going to change back. That's how the law is written today. And then again, looking at the Secure Act, we'll look at the pros and cons of converting. So we want to really study this. We've been studying it. We want to do even more this year. And the reminder on December 20th, 2019, again, the major act known as Secure Act was signed into law. This was already bringing massive changes to those of us in retirement savings before the pandemic and the CARES Act was passed. The thing that's key on the Secure Act, there's really two things. It's being able to convert into Roth IRAs, number one, and being able to do it without staying in those low brackets. And secondly, being able to avoid those required minimum distributions into the future. So people in their mid 60s, early 60s, great time, they're retired in those lower brackets now. Just a wonderful time to look at this. But it's also on the back end of things from the estate planning situation. It also changed the inherited IRA situation. It eliminated the inherited IRA, and now when your kids inherit these, it's a new 10-year rule. And it says that most investors, they can no longer stretch out their inherited IRAs. So they need to plan to take these funds out over a 10-year period. That means we need to be, one of the things we're doing is reviewing your retirement plan and your taxes and determining getting more you can get into this Roth IRA later on. Your kids still have to take the money out, but they're doing it tax-free versus taxable. It still has to come out over a 10-year period, but you're in a Roth IRA now and not in a traditional. Some of you it will matter to, some of you it won't. So, but we want to have the discussion and make sure, again, that you understand it so we're making educational decisions. The deadline, most of you know this. Just a reminder, the deadline for filing 2019 income tax returns officially changed to July 15th, 2020. Also, the deadline for making 2019 IRA and SHA contributions also moved to July 15th, 2020. The deadlines for contribution to workplace savings plans, the 401k plans, I've talked to a couple of you, be careful here. It really depends on how your plan is written and what state you're in. Some of you can, some of you can't. And also it depends on, for the company contributions and your normal contributions, they're due by the end of the year. The catch-up contributions, depending on what state you are and how your plan is written, you may have longer. Volatility, equity market volatility is definitely back, and it's definitely scary. I don't like it either. That's why we need to proceed with caution. Again, the media, I can't speak enough on this. They create the panic and fear. They make money on that. That is their best time to make money. And unfortunately, it causes you to make panic and make bad choices. The media magnification of the current financial crisis is really putting a major emotional strain on a lot of people. And that's because we're stuck at home and you can only do so much walking and watching so many movies, right? But it's during these times, you have to be prudent and resist the temptation to watch this news and obsessively watching your portfolio. Let us do it. Believe me, we're stressing out enough for you. You don't need to do it. Sometimes the more information you have, the more likely you could have a decision that deviates from your long-term strategy. I said that a lot to you, those of you who come through my class. It's unfortunately, I think there's so much information coming today, and over 90% of it's bad information. We want to adhere to a long-term investment plan, and requires taking the news with a grain of salt and putting the impromptu advice of others on the back burner. I can't tell you how many people I've had, my friends said this, my friends are saying this. These guys they're experts and pros. I got to tell you, I've been doing this 28 years. I'm going on 28 years now professionally, another 10 on top of that personally. Not many people in the media or your friends that are probably having my experience at this point. So I'm right there with them. I understand. So, and I'm telling you and asking you, be very, very careful of friends, family, people saying things to you, the media. A lot of them could use my class. So as a recap, some takeaways for you. 2019 produced strong returns for equity investors. The volatility has emerged in 2020. And this is going to be a wonderful time as we move forward again in the next 12 to 18 months. We're really going to be able to look at a really good time, a really bad time. We're going to look at risk tolerance, how you came through it, and know and remember that this will happen again. Somehow it'll be different, but it'll happen again. And we forget though, it's been 11 years since we've seen anything like this. And we forget. So the first and foremost, your health is our priority. I want to make sure everybody's healthy and you're staying safe. Without that, we've got nothing. So continue to focus on your personal goals, and please call or email us anytime. We're here. We can only go back and forth. We're not meeting anybody. We're not doing any workshops. That's why we're sending out these in a video type thing. I like seeing everybody one-on-one. I like having a glass of wine with some of you that enjoy wine. I like eating with you. So I much prefer how we do it normally in normal times than this. But I would look forward to seeing all you guys. I miss seeing people and talking to people. It's been a strange, the last 2 months, it felt like 10 years. So, and again, what you can expect from us is we want to continue to be regular communication. That's why we're doing these videos to you. I try to call as many people as I can. I try to get back to you as fast as I can. Sometimes things come in here as a machine gun. Please be patient with us. We'll get back to you as fast as possible. Some of the questions you have and just some of the strategies, sometimes going through the Secure Act, the CARE Act, it can take me a couple hours to figure out an answer to something given everything that's going on here. So please bear with us. We will get back to you. I want to thank you for your time today. And again, your health and well-being is our highest priority. We really appreciate and thank you for letting us assist you in your financial needs. If you know of anybody else that having issues, that are worried, that need good information, we'd be honored if you'd share those names with us, and we'll put them on our list and they can get these videos as well. We usually do that in our workshops. We're not able to hold those, but we'd be honored if you share those people with us, and we'll get them this information as well. And we'll keep getting these updated. We'll get our letters. We're going to continue to send out our quarterly letters, our monthly letters. We're going to continue to do these videos as we get through this. This is going to take time. I think the markets will continue to stay volatile. So we're here for you. I appreciate each and every one of you. I miss seeing you. And we will look forward to our next quarterly reviews. We'll either do them by phone the first week, but I suspect it'll probably go into most of the month. We've changed them to either a Zoom meeting or a phone meeting. And then going on, we've got office meetings set up, to set up office meetings. But I suspect at some point, I think we'll see that. We may be wearing masks in front of each other, which that'll be interesting. And by the way, you can't get into Costco now if you're in Oregon without a mask. That just came out yesterday. So I think we'll see more and more of that as we open back up. So with that, I hope you have a great weekend, and we'll talk to you soon.